Is the Bank of Canada about to crush housing affordability? What if I told you a routine move by the Bank of Canada could quietly push your dream home even further out of reach? And what if the same decision could squeeze investors, renters, and even boomers planning to retire on their home equity, all at the same time? Today we're talking about the Bank of Canada restarting its Treasury bill purchases on December 16th, why this matters way more than it sounds, and what you can do to protect yourself, whether you're a buyer, an investor, a renter, or planning your exit strategy. Stick around because ignoring this could cost you years off your financial plan. But I do have good news at the end of this video, so stick around. So what's going on? The Bank of Canada is resuming routine purchases of short-term Treasury bills, or T-bills. These are government debt securities that mature in a year or less. On paper, this is about keeping a balanced mix of assets on the bank's balance sheet. But here's the debate. One camp says, relax, this is standard operating procedure. The other camp says, hang on, you're injecting more liquidity into a system that just went through a massive inflation shock, and that's not nothing. When the central bank buys government debt, it can effectively expand the money supply. And when there's more money chasing the same goods and services, that pressure often shows up as higher prices. Now remember, we just lived through that with COVID. Food, energy, supply chains, everything got more expensive, and household budgets got hammered. So the question is this: does this move risk reigniting inflation, or does the bank manage to thread the needle? By the way, please like and subscribe and share this video to get the news out to more people who need to hear it and plan their next move. So here's the natural chain reaction. Higher inflation equals higher interest rates equals more unaffordable housing. Now let's connect the dots to your life. If this contributes to higher or stickier inflation, the usual response from the Bank of Canada is to raise interest rates or at least keep them higher for longer. Higher rates mean more expensive mortgages, tougher stress tests, and lower borrowing capacity. For first-time buyers and urban buyers already fighting high prices, that can mean the house I could afford last year, I can't qualify for it now. Or I qualify, but the monthly payment is just too tight. So a technical move like buying T-bills can end up widening the gap between what people earn and what they need to carry a home. Now this just isn't an inconvenience. For a lot of Canadians, it's the difference between owning and renting indefinitely. Now what about investors? They'll have squeezed margins and tough choices. So when we talk about investors, we're talking higher rates and higher operating costs to do a few things. Mortgage payments go up, insurance, utilities, maintenance, and taxes are often rising too. Cash flow that used to be comfortable can get razor thin or even negative. For leveraged investors, this is a moment where some will need to re-underwrite their portfolios, which properties still work and which won't. Some may look at refinancing, selling underperforming assets, or restructuring debt. Others, especially those buying smart, will use this period to negotiate better prices and terms from sellers who are under big pressure. This is where knowing your numbers matters more than ever. Cash flow, cap rates, debt coverage, and exit strategies can be fuzzy concepts, but they have to be clear. So what about renters? Are they caught up in the crossfire? Well, if you're renting, you're not off the hook either. When landlords face higher borrowing and operating costs, well, they often try to pass some of that through the form of rent increases within whatever provincial rules that apply. In tight urban markets, that can mean renters facing increases that outpace income growth, people being forced to trim everything else in their budget just to keep a roof over their heads, or relocating to less desirable or more distant areas just to find something affordable. So even if you're not buying, interest rate and inflation dynamics absolutely show up in your life. Now let's talk about boomers, a huge group who often see their home as their retirement plan, full stop. If you're counting on selling your primary residence at a strong price or downsizing and freeing up this huge chunk of equity, a higher rate, a slower moving market can create real friction. If buyers are squeezed by tighter financing, it can delay your sale in an already slow market environment in many areas, put downward pressure on offers, or force you to adjust your expectations or timing. Now that doesn't mean the sky's falling, but it does mean boomers should be more intentional about when they list, how they price, and what their plan B and plan C look like if the market doesn't move as quickly as expected. So what do you do about it? Well, here's the good news. Chaos does not automatically mean catastrophe if you adapt early. So whether you're a first-time buyer or a homeowner thinking of investing, or a renter trying to get ahead, or a boomer planning their exit, there are smart moves that you can make. For example, buyers, get pre-qualified early, understand your numbers, and be flexible on property type or location. For new investors, focus on fundamentals like cash flow, long-term growth, and your personal risk tolerance. For existing investors, you have to rerun your math on your portfolio. Which properties still make sense in today's rate environment and which don't? And maybe you need to sell one. And boomers, talk through timelines and scenarios. What happens if it takes 3 to 6 months or longer to sell? What if your property value is less than you expect? How does that affect your retirement plan? And this is where having a realtor who actually understands real estate investing and macro trends, not just bedrooms and bathrooms, these realtors become incredibly valuable. You want someone who can translate these big Bank of Canada moves into practical advice and help you stress test decisions and spot opportunities that others may miss because they're only focused on fear. I'm referring to a realtor who has the Real Estate Investment Specialist designation. And this is accomplished by completing and passing a comprehensive training which equips realtors to recognize and communicate effectively about client strategies, as well as cash flow analysis, deal structuring, and creative financing, the keys for building wealth over time. So as the Bank of Canada gears up to restart T-bill purchases, don't tune out as it's boring central bank stuff. It's all connected to inflation, to interest rates, to your mortgage and your rent and your retirement and your long-term wealth plan. If you're wondering what this means for your specific situation, whether you're looking to buy, sell, invest, or not get blindsided, reach out, drop a comment, send a message, or book a quick call with me. Let's make sure that you're just not reacting to headlines, but actually positioning yourself to benefit from what's coming. If you found this helpful, hit like, hit subscribe, and share this with someone who's stressing about the market right now. They might need to hear that there are still some smart moves to make. See you in the next video.